Hello, everyone. I'm happy to be here. You're welcome to the Dr. Inia Desnia show. Very excited. I want to just say I apologize because I should have said that I won't be on for the last, I think, 2 weeks. I had some engagements which I had to attend to. So I really want to apologize because usually I tell you guys before when I'm not coming. So I'm sorry about that. So anyway, I'm very excited to be back, and we're rounding up the year. I'm very very excited. So I'm happy to be here. So just wanted to say thank you again for those that have commented, watched. I'm very very grateful. It's very wonderful. I know you could have done so much this evening, but you decided to watch my show. All right, and of course, this platform is where I share resources to help SMEs thrive. I know someone asked me, what is SME? I said, okay. I thought I guess that was the first time the person was watching. SME is small and medium-sized enterprises, just how to make them thrive. All right. And so I share resources, do my best. Of course, everything here is for educative and informative purposes only. It's not just to if you need a professional, please reach out. And of course, if you want my services, the service of my practice, please reach out also because this is just general information. All right. Okay. So excited to be here. So let's get started. Today I'm going to talk about, anyway, let me step back a little bit because I've talked about how, tax savings for entities, right? Now, a lot of entities that I talk about, apart from the C corporation, if you're in the United States, C corporations are entities that don't do flow through. You're taxed at the level of the corporation. But in this case, we're really now, this case, I'm referring to flow throughs where you're taxed on the taxpayer's return, right? So what that means is that if you're an owner of either an S corp, you're a shareholder of an S corp, or you're a LLC member, you're not taxed really on the maybe a partnership return or on an S corp return. Your tax actually you get a K1, which means K1 is what goes on your tax return as a taxpayer. So I'm really today going to focus on business owners, right? Zero in on how they can actually make savings as business owners because these pass-through entities flow through to their tax returns. And we also have to look at generally, because at the end of the day, what do you want to do to reduce your tax liability? You don't want to spend so much on taxes, right? Of course, we're not talking about tax evasion because tax evasion is criminal. We're going to talk about tax avoidance. So I'm going to give you a couple of points. How do you actually avoid taxes? All right. So let's get right into it. So the very first thing that you can do is, I know that even entities can do this, right? Entities they can actually, first of all, donate to charity. I mean, it's so wonderful when you want to donate to charity, right? I know, you have the passion to do that, which is awesome. But you know what? It's actually tax advantageous, right? Now, I know that the standard deduction has increased. I don't really want to get to the nitty gritty of the tax return because I mean, this is just for small, medium-sized enterprise or business owners that might not be so conversant with tax returns, like every detail on the tax return. All right. So but I would say that if you give to charity to a certain amount, you can actually deduct that on your return. Now, sometimes we feel that the amount we've given doesn't meet the threshold, right? That the government already gives us. And so we talk about you bunch your charitable donations, bunch them, put them together. And there's a way you can do that. Very important for you to talk to your financial advisor that, okay, I want to bunch my um charitable donations. So that's very, very important for you to think of that. Another way you could actually think of reducing the taxes that you pay is, I know that we talked about um retirement funds. I don't want to go through the list, we know, but just generally, we talked about several retirement funds that companies can have. Now, I'm just going to explain to you between the difference between the Roth, for example, Roth IRA and the traditional IRA. Now, the Roth IRA allows you to deduct, to deduct, or the traditional IRA actually allows you to get a tax. The taxes, you don't pay taxes on the traditional IRA, right? You pay taxes when you withdraw the money. Roth is different. Roth, you pay taxes now as opposed to paying taxes when you withdraw the money, your retirement. Now, let me explain to you why not one shoe fits everybody. I want you to understand that it's not because I wear this shoe for the purpose of Roth, Roth and traditional IRA. It's not because I wear this shoe that you should wear the same shoe. It just depends. Of course, you can wear the same shoes. That's not a problem. I'm pleased. I'm not talking about shoes generally. I'm talking about Roth, the shoe of Roth, and the shoe of the traditional. Now, if you analyze and say, oh, you know what? I'm gonna make more money. I'm gonna make more money, right? I'm gonna have a higher tax bracket at the end of when I'm retiring, I'm gonna have higher tax bracket. What people do at that time, they say, okay, because of that, I have a lower tax bracket now. So what I'm going to do is that I'm going to pay the taxes now. So by the time I'm withdrawing money from my retirement, those withdrawals are what are tax free because I've already paid the tax upfront. And that's why I said you should always talk to your tax practitioner, your accountant, to make sure you're analyzing it properly. Now, if you know that at the end of the day, you're going to get less money, you're going to retirement, you're making a lot of money now, so you're going to get less money when you retire. Then when that happens, right, you will just say that, you know what, I want to pay my taxes later, right? Traditional, right? So if you believe that it's going to be the same thing at same level, okay, then consider converting converting your Roth to traditional so that you can actually benefit from it now and pay less taxes now. All right. Okay, very important for us to know that because a lot of times people don't analyze. They just feel that okay, a friend of mine is doing having their retirement under a Roth IRA. I'm going to do the same thing. No, no. So, but if you convert from Roth to traditional, what happens? You are reducing your tax liability because remember, I said Roth at this time. What are you doing? You're actually paying taxes at this time if it's a Roth IRA, right? So you're reducing your tax exposure. All right. All righty. So another way you can really reduce, so I mentioned donating, right? Another way you can actually reduce your taxes is, look at your investment. Consider, how your investment going, right? You might have some investments that is very important that you look at. How are you investing? Now, I can actually step back because I know I talked about flow through entities, right? I have to make sure that we understand here that when you're talking about flow through entities, now the LLC really doesn't have a lot of should I say a lot of let me say an LLC, they have some kind of specific strict criteria, but an S corp has a lot too. And so when we're talking about investments, right, make sure that your investment on an S corp side, because it's also flow through, right? I know I'm going back and forth, flow through, and I'm coming to your tax return, but I just want to step back a little bit because as I'm talking about investment, looking at all your portfolio, make sure that when you're looking at an S corp, assuming that your S corp is what really is the platform you're using to invest, make sure that 25% or less is passive income. All right. Make sure that because if that doesn't happen, what happens? If you don't do that, what happens? The S corp loses its status as an S corp, right? You don't want that to happen because I mean, a lot of people would say that, okay, yes, I'm using my company to do everything. Yes, it's good, but make sure that 75% of that company, right? An S corp company, 75% or more. Okay, not less than 75% is actually active business. What do I mean by active business? Now, let's say I like using practical examples. Let's say your business is let's say retail. Let's say your business is retail. I know that's what's really huge right now, because what's happening, the holiday season is just round the corner. So let's say retail. Now, make sure that whatever you're selling, whatever the retail, which is your trade or business, that you're working your retail business, right? Make sure that 75% of income is coming from that retail business, right? Now, if you want to invest, some people have investment and put it aside and say, okay, I want to invest in this, I want to invest in that. That is fine, but make sure that not more than 25% of that investment is what? Make sure that it's passive. Passive. What is passive? Passive means something that um you do not have you're not actively involved. All right, you're not actively involved. So make sure that's the case with your passive um activity. All right. Then another aspect is that I would say is that it's so important that you do what? You look for all your deductions, right? Make sure that, in addition, I already talked about, if you look at my past um, show, you would see that I already spoke about how you maximize your deductions for your business. But even, putting in how to maximize your deductions too within your own platform of your tax return. I know some of us might know this already, but the Tax Cut and Jobs Act, okay, you know what? You might not, I don't want to get into too much technicality, but let me say a tax law. A tax law. I don't want to, but I don't, but it's TCJA, but let me not really break it down. You know, um, if you really want to deduct interest, right? Interest from your maybe home equity line of credit or something like anything like a mortgage, make sure that any money you're taking is used for to improve your primary home or your primary residence or an additional resident. You can do that. You cannot take, you can, if you take more maybe equity amount, right, and use it for investment, that interest is not deductible. All right, so you one needs to be careful. That interest is not deductible. All right. Also, make sure you maximize all your deductions. Look at anything that you might have spent. It could be medical, it could be home improvement. The reason why I'm drawing on home improvement is that if you use, a lot of people are using their homes as a home office, right? Home office. So home office, make sure that you keep all your receipts. When it comes to the expenses related to your home office. Make sure you keep all your receipts and take that deduction, right? I always tell people, as much as possible, I love receipts. It's not that it's bad, but please, as much as possible, use a debit, credit, wire, whatever, check. I really do not encourage anyone to pay for expenses with cash. Because, I mean, if you have to, I get it, but the reason why I advise you not to do that is because you cannot really trace that cash. Now, um, I know that we have receipts, but sometimes receipts get missing. I hope it doesn't, but I know how I'm talking about someone that is just normally they're generally they're not really accountants, or we know we are strict with receipts, but sometimes receipts get faded, get missing, or but when you use your credit, your debit, your check, your a wire, what I mean, anything to have a paper trail, you can actually go back and say, okay, this is what I spend this money on, right? I've always mentioned that you should not commingle funds. What is commingling funds? It means that some people don't have a separate bank account for their business, right? That is totally wrong. And the reason why I say that is that if you don't have a separate bank account, for example, let me give you a typical example that can happen. right? You go on a business lunch, you swipe that account that you don't that is not separate from your business, right? You swipe that account you swipe the card with swipe the card, okay, swipe the card, and because yeah, it's a business lunch, so it's allowed. But remember, it's not. It's commingled. Commingled means together. You mix things together. Now, imagine you taking your family. You go out with some friends, or you go out with your family, and swipe that same card to the same restaurant, for example. How would maybe if you get audited, how would the IRS say, oh, know that this is for business, this is not is for personal? How would that happen? I mean, even if it's not the IRS, if somebody says, "Let me see the account," and how would they know that? Right? So it's very important for you to separate. But in respect, I use an IRS as an example, but because IRS, I mean, of course, they can deny your deductions, right? You can say, "Oh, this one is for my friends," or when I went, or "This one is for my friend. This was when I went for a business visit," right? I mean, it's not really defendable. So really, and then you know what can happen? IRS can deny all the deductions, and you know what can actually happen? Then you know what? They add it back, and that increases your increases your tax liability. You don't want that to happen. All right? You don't want that to happen. So, I mean, these are a couple. I mean, I know we could go. I already explained to everyone that if anybody has listened or watched my program, it's very important for you to have, of course, a retirement plan, of course. And and then also the HSA and the FSA are very important for you to know that, because it depends on which one you choose. I'm not going to break it down because one is flexible spending account, one is flexible spending account, one is health savings account. What happens is that you already, some of us pay deductibles, some don't. Now, you know that deductible for, when I say deductible, is when you go to see the doctor. Now, you know that that deductible, what? The deductible is what? Is after tax. Most people pay after tax, right? Is what you get into your hands, maybe from maybe your company gives you a W-2 and you pay. So what you have in your hands is the what you use to maybe to actually do things, right, including pay for your deductible. But an HSA account, right? For let me take an HSA, there's FSA, but let me just say any of those accounts has an amount you can contribute into that account where you can spend on health things, right? Which is deductibles when it comes to doctor visit and just health, anything related to health. That is actually a great thing because it's tax free, right? The goal here is to really reduce the amount of taxes you pay as a taxpayer, right? And I'm really focused on flow through entity owners now, because the C corp, what happens is that it's taxed at the level of the corporation, and of course, if you want to get a dividend, you get a dividend. All right, so very important. All right, so we talked about the retirement plans, right? Another way, making sure that everything that you're doing is fully documented. All right. So generally that's tax saving strategies for general and for actually taxpayers. Now, as much as possible, um, you can actually make sure that you and I mentioned that capital, I mentioned interest, but I don't think I mentioned capital improvement, right? Now, there are times that you might want to improve or do things to your homes, right? Now, if you're doing anything to your homes, major capital improvement or even expenses. Now, if you mentioned working from home, right? I mentioned interest. I mentioned that you can have a home office. Now, if you do any capital improvement, I'm going to talk about it in two different ways. Now, if you sell your property, that goes against the selling price and the basis. That is not the selling price, the actual cost of your property. All right. But let's assume you're not selling your property. what can you benefit from those capital improvements? What can you benefit from those expenses? Now, if you have a home office, right? Now, having a home office, those expenses can be deductible. The capital improvements are added to the cost to the value of the house leasehold, or just improvements, yes, added to the value of the house. And what happens, you can actually depreciate. The depreciation is added to as is allocated as per. Remember, added to or deducted from your tax return, right? Not added is I deducted. I want to make sure I make sure I make sure that we understand that. Now, when we're talking about home office expense, please let's note that there are direct and indirect expenses. Direct expenses that are directly allocated 100% to your home office, that it only affects your that space. So in that case, 100%, the 100% of that cost, of that expense, is deductible. For example, if you have a home office and maybe somebody comes to repair just the floor of your home office, 100%, that 100% is 100% deductible because it's just the floor of your home office. Now, things like gas, things like electricity, things like that are what allocated. So is what their indirect expenses, right? So that means that if the cost of, for example, the whole year you had maybe for utilities for the whole year you had maybe 12,000, right? For utilities for the whole year, right? And the amount that, or the space you use for your home office, let's say, is 20% of the house, right? So that means that it's going to be 12,000 times 20%, right? Right? That will be allocated to the expense for your home office. So that's just another way that you can actually make sure that you're deducting all the expenses. A lot of people might not know that, because a lot of people might make the mistake to deduct everything. Now, it just depends. Is it directly related to that home office? If it's not, definitely do not deduct. All right. Or deduct based on the certain percentages. All right. Okay. And then also, if you have I know casualty losses are not right now there's on suspension, right? But there are certain losses. Now, it depends on where you live. If you have suffered a loss because of any of these disasters that are happening, please make sure you take that into make sure you, first of all, we sorry about the disaster, but make sure that you are really benefiting from that in respect of deductions. Not that you're benefiting because we're not happy with all those disasters happening, but you can just make sure you are able to take that deduction. All right, because it's really allowed. All right. Now there's several. I can't go through every single thing because of time, but I just wanted to make sure we understand, because the reason why I said I would share this is because the year is coming to an end. I would advise everyone that is listening, please go and speak to your accountant. Of course, you can come and speak to me if you don't have an accountant, because at this time, what I'm doing is meeting with my clients to actually do tax planning, sit back and say, okay, what can we do to make sure that before the end of the year, everything is okay. And also, those that are planning, we plan for the upcoming year. So it's very important for you to listen. And, listen to what I'm saying, hopefully. And also, take this, and of course, as I said, it's for informative and educative purposes only, but take this and really sit in front of your accountant and said, okay, this is what I got from the Dr. Nia Desnia show. Is there anything I need to adjust? And does this apply to my situation, right? Does it apply to my situation? Another thing that is so important for you to add is that, if you have taken advantage of like solar, using of solar, those credits, solar using, installing solar to use in your home. If you've taken advantage of the the EV, electrical vehicle, things like that. There are actually credits out there, right? Credits out there that you can get. Now, it depends on where you're located. There are actually credits even that are related to your states, that state credits, right? So it's very important for you to know which one applies. I know that some people that even install a storm room, right? Check if it applies in the state you're in, right? Make sure you're checking. There are some states that don't have tax. They don't have there are some states that don't have taxes. Yeah, there's no income tax, but there are some that do have income tax. So it's very important for you to sit back and really look at, when you sit back and get a paper or type it out and say, okay, these are some of the adjustments or improvements I made in my home. Remember, I talked about general capital improvement, but this one I'm going a step further to say, in addition to general capital improvements, you can actually have improvements that actually give you credits, right? Credits, right? In addition to that, and the credit, this goes beyond you having a home office. I want you to understand that there are some credits that go beyond that, you're having a home office. All right. So it's very important for us to understand that. So which credit applies? Do not take anything for granted. What I tell my clients is that write out everything, type out everything, email me everything that you want to email, send me an email regarding anything and everything that you're not sure of. And we can, what doesn't apply, I will just take it off, right? But don't second guess, don't assume, because one thing that happens is that tax laws continue to change. They just continue to change. So you might say, oh, this didn't apply, or this didn't apply last year, but what about if it applies this year? So it's very important for you to be up to date with changes in the tax law, making sure that you understand what applies. And if you don't know those changes, please make sure you visit us. Or, if you do have an accountant, make sure you work with that accountant. Okay, awesome, 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 great. So let's go with some questions at this time. Um, see some questions at this time. So the questions I have, there are a couple of questions. Okay, so is it better for me to file married filing jointly or married filing separately? Okay, very good question. Remember, today I'm talking about the tax return of business owners, right? Right? Tax return of business owners. Now, married filing jointly is really good because you get credits that you will not generally get if you file married filing separately. I just want us to understand that there are various credits. There's the earned income credits. There are various credits that you actually do not get. You can't get that if you file married filing separately. So that's the very, very, very big thing, right? But I want to make sure we understand this. There are some times you have to file married filing separately. I have cases that I said, you know what? Yes, you might lose out on credits, but this is likely the best way to go. When does this happen? Now, assuming that your spouse has a lot of debts, right? Before you even met him, he had it, or met her, a lot of debt. So, people don't know this. Well, I won't say people. Some people do. So let me not say, people, but if you file a return with your spouse, it has to be, with your spouse, and let's say both of you owe $20,000, because that's, for example, and what the IRS says is that you are jointly and severally liable. What does this mean? It means that, let's say, spouse A and spouse B. What this means is that the IRS can come after spouse A for 10,000, 20,000, 55,000, anything, for, regardless of spouse B, can say that I'm getting the 20,000 from spouse A, right? Or you can say that I'm getting the 20,000 from spouse A and B, or spouse A or B. That's how it is. That's joint and severally. So it could happen that this person, for example, has a lot of debt, right? Maybe past debt. And the person will say, you know what, tell the spouse, will tell the spouse that, I don't want you to get mixed up with this debt, right? I don't want you to get mixed up with this debt. So we're going to file separately. I've seen cases like that. So as much as so advantageous to file married filing jointly, right, to get so many credits, but if it's going to result in something that is beyond the credit, I always advise taxpayers to really look into that to see if married filing um, separately would work better. All right. So again, the credits, you might lose them. You will lose them if you do married filing um, separately, but it just depends on which one works for you, right? Why would you maybe the best way to go about filing your return is married filing um separately, all right? But also to add to this, because I've seen this mistake a lot, and I want to add to this, even though the question is not here. No, now head of household, many people make that mistake, and just put in head of household when they don't have any dependents. Please make sure you know that if you don't have any dependents, and if you are married and you don't have dependents, um, or you're married and you have it, okay, you first of all, if you're married, you cannot file head of household. Okay, if you're married. Secondly, if you're married and or if you're not married and you don't have any dependents, this one you're not married, you cannot file head of household. Okay, that if you file that if you take head of household, if you pick head of household, that's incorrect. And I want to really stress here, please and please go through your tax return when you receive it. Make sure you go through your tax return, because I've seen cases that when those documents are brought to me, a tax return, a past tax return that is brought to me, and I see, especially that status, I see that something is incorrectly ticked. I will ask, I said, why is this ticked? Oh, really? Is that ticked? Oh, I didn't know. I didn't know. I didn't know that's I didn't know that it was ticked, right? That is really, really no excuse, right? I mean, I will tell you that for me, I mean, there's no excuse. There's no excuse. For me, it's okay because I mean, I'm not the government. I'll just tell you, but that is wrong. But if you get audited and you say, oh, oh, really? I didn't know. But you signed the document. So I will say before you sign any document, make sure that you're checking, you're really, really checking that. All right. Okay. So the next question is um, for mileage, is it better to take the standard deduction or actual? Very good question. Um, Now, I'm sure this is someone that, of course, someone that has a C, no, not schedule C. Schedule C. So business, is it right to say standard, to file standard, or pick up the standard mileage, or to take the actual? Now, if those that don't know what that means, actual mileage is or actual expenses, not actual mileage. Actual expenses is taking exactly all the expenses, taking all the expenses you actually incurred, right? All the expenses you paid for, right? Expenses like, I mean, car repairs, expenses like car wash, expenses like oil change, expenses like gas, right? So is it yeah, the question is that which one is better? Well, most tax returns, most tax softwares, they actually see what works best, right? But one thing I see with the standard and I see with the actual, which is the standard, does not ask you really for details of okay, gas, but of course you have to know how many miles you drove during the year. Yes, very important. But for the actual, you take actual expenses, you have to come up to make sure that you have the correct amount for gas, correct amount for repairs, correct amount, and there are people that are so good in actually having the list and getting those things together. Very good. If you're good, I mean, that's not a problem. But I'm just saying that if you want to come take actual, make sure you have your documentation in place. All right. Have all your documents in place, have all your support in place. You might say, oh, but not everybody gets audited. You're correct. But how about if you are the percentage, you fall within the percentage that gets audited. All right. So very important. So again, standard mileage, nobody really worries about the cost or all those receipts. But you have to actually substantiate the mileage and said, yes, if you drove 10,000 miles, 12,000 miles, 11,500 miles, 5,000 miles, you must actually be able to substantiate and say, yes, this is the number of miles that I've driven. All right. Okay. So another question is um can I make my passive income become active income? Okay. I know I mentioned passive income briefly, but let me just go back and re-emphasize or explain it again. Passive income is income that you're really not doing much. You're not really doing anything, really. Yeah, so like I mean, for example, investment. There's some investment you get interest, that's passive income. You're just passive, you're not really being very you're not actively involved. So the question is, passive income become active, can become active, can it become active in maybe passive work, or would I say passive investment that generate or that you have that is passive? Definitely, yes. Yes, you can. You can. Maybe there's something that you were not very, there's some jobs like maybe you're for example, you have let me give an example. Let's see. You have a car station that you just or a car lot, I should say, that you just invested in. You just said, okay, you know what? I'm investing in this, right? And that's what you're doing, you're investing. Then you decide to come in and become the manager of the car lot, right? Become very actively involved with the car lots, become part of management. Of course, that's you see how you change passive to active. Now, I want us to be very, very clear about how you classify active. Now, there are some criteria for someone to be actively involved in a business. And one of the criteria is that you have to work for 750 hours. Have to work for 750 hours, which is very important, right? Among other things. So it's good for you to know that. Why is this so important? That, oh, what is the big deal between active or not active, passive? It's because the active income is like business income, and you can deduct your losses or not expenses, sorry, deductions. And if you can, it goes against active, it goes against, would I say, ordinary income. I would say ordinary income. It goes against ordinary income losses, right? But if something is passive losses and passive income, passive losses goes against only passive income, but there's an amount that is allowed to go against ordinary loss, which is net ordinary loss, which is $3,000, right? So that is what the importance. So imagine you making hopefully not a loss of maybe 20,000, right? And you have a salary because you work with your S corp. You have a salary. You have that salary. Let's say you just for the purpose you made, let's say 250,000 of that year, or maybe 200,000 just for the purpose of this 250,000. Let's say, but you had an investment loss, and then of course with the K1, that includes the K1, coming from an S corp. Then because that you made a $50,000 in loss, let's say for the purpose of this discussion, you can only deduct $3,000 from that. That's your 250,000 you made, only $3,000. And that's why, but if everything was active, if everything was ordinary income, you can deduct the whole 50,000. So that's why that question has become very relevant. Passive income, active income, sorry, passive income, trade and business where you materially participate, right? So yes, you can actually change or convert your passive income. You can, if you're active in it, right? You can actually do that, right? So very important for us to note that. Okay. And so another question is has to do with um let me see. I think I think I can do take one more question. Okay. The question is, I believe I don't I think I've come across something like this before. Okay. Um, is it better to lease or buy my business vehicle? Wow, good question. But I believe I mean, I would advise you to go and listen or to watch my show, but I'm going to just summarize a little bit. I would say, first of all, if you buy the vehicle, is yours, right? And you can take the depreciation, you can take that deduction, right? If you lease the vehicle, you just have a lease payment, but the lease payment depends on I mean, it depends on the value of the yearly value that you can take. Depends on there's an inclusion amount. There's an amount that you can take. I mean, there's depends on how much you lease the vehicle with. So it's not yours, because the one for the business, the depreciation is more, and then you take a higher deduction, but it still depends because um, if you use the vehicle, I mean, of course, people try to take the other side, the lease, because it's cheaper. But you have to understand that it depends. If you are someone that drives a lot, right? Drives a lot, right? Now, if you drive a lot, there's an additional cost on the lease part if you drive a lot. So yes, for tax purposes, yes, business, yeah, getting that business vehicle because of depreciation, the advantage of the cost deduction. But remember, when we're looking at this platform, we're not only looking at tax, we're looking at cash flow, we're looking at cost benefit analysis. So you have to look at what works for you, right? So it just depends. So that's why this is a topic that I really discussed at length. So I would suggest that, or I would advise that you go back and look at my show, watch my show where I specifically talked about whether you should lease a vehicle or you should buy the vehicle, right? There are various advantages, there are various disadvantages on both sides, but I have to say that it depends. Sometimes you might say, you know what, I don't want to invest this kind of money. It's a capital intensive, it's capital intensive for me to buy a vehicle at this cost right now. I don't want to do that. So again, it just depends. All right. Okay. So again, watch the show and find out which one works. All right. So yeah, I'm very happy to be back. I should be back again next week, but I just wanted to appreciate everyone that is here, everyone that has watched, and of course, continue to send your questions in. If you don't have a CPA that you're working with right now, please reach out to my office and definitely we'll set you up with an appointment so we can work together. I also want to say that that's or hopefully I'm doing the wrong side. That is the website. If you want to appear on the show, if you have some questions, please, that is the website. Just go there, www.driniadesnya, one word.com. So it's driniadesnya.com. So thank you for being here. I know you could have spent your evening doing something else, but I'm happy that you were able to be part of this show. All right.